We have a quick question here from Phalanx who asks, what is the difference between dovish and hawkish, and in what context are these two terms used? So thanks for the question. These two terms can be used in a couple of different ways, but ultimately they come down to really mean the same thing. And firstly, let's talk about dovish and hawkish in terms of central bankers. So as you know, every major central bank has various members, and each of these members usually has a specific disposition on what they think the best strategy is to follow in terms of monetary policy. So when a central banker is called a hawk, it is someone who usually advocates for tighter monetary policy. So it'll be those types of policymakers that would usually be in favor of higher interest rates and reducing borrowing in the economy. On the other end of the scale, you have monetary doves, and they are members who usually advocate for looser monetary policy, and they will be the ones who are usually more in favor of lowering interest rates and stimulating the economy to increase borrowing, etc. Now, just because they are thought of as a dove and a hawk, it doesn't necessarily mean that they will always want higher or lower rates. So, for example, let's say we are in an obvious recession and an obvious economic downturn. It doesn't mean that the central banker who is known as a hawk will want to hike rates in that environment, right? But it might mean that they would want to cut rates less and provide less stimulus compared to a monetary dove. And in the same way, if the economy is absolutely booming and growth is picking up, it doesn't mean that just because someone is a dove, they will automatically want to cut rates in that environment. They will also vote most probably for rate hikes in that environment, but they will be skewed to hiking less and will probably be the first ones to dissent when they are nearing a turn in the rate cycle, and will be the first ones possibly to vote for interest rate cuts. So how can you use this information? It's quite simple, really. In our terminal, in the Financial Source terminal, under the currency research section, we actually have a section called Central Bank Analysis, and in there we have a Hawks and Dove cheat sheet for the ECB, the Bank of England, and the Federal Reserve. So if I open up the one for the Federal Reserve, you'll see it basically gives you all of the members. It gives you their current position in the central bank, and it also gives you their policy stance as well as recent comments that they've delivered. Now, how you can basically use this, once you have this information, you simply need to wait for these speakers to have speeches and listen to their communications. So for that, you can use any type of calendar. I use this one on Reuters Zenith, and it gives me all of the upcoming speeches for a particular day. So I know that, I'm looking at Fed's Williams coming up. I have Fed's or BOE's Andy Haldane, chief economist, coming up. So it gives me all of the various members that might be talking. So I know which ones of them are hawks and which ones are doves based on that cheat sheet. And then I know also when they are speaking. And what you're basically looking for is when somebody, for example, is known as a hawk, saying something hawkish or in fitting with tighter monetary policy isn't really going to be that much of a surprise to the markets, because the markets already know that they are a hawkish member, wanting tighter policy. So it's not going to be too surprised if that happens. And same story for a dove. If they come out saying something very dovish, that's not really going to be very surprising. Of course, depending on where we are on the rate cycle, it can make a difference. So if a hawk comes out very hawkish, it might still move the markets. But the thing that you're really looking for is, imagine somebody that is a known dove, which now is somebody who wants looser policy. Imagine a dove comes out and says something very hawkish, maybe hinting that they would be voting for a potential rate hike at a next policy meeting when the market might not be expecting that to happen. That can create great trading opportunities and create great sentiment shifts. So the key is to know what their policy stance is before they speak. So know whether they are doves or know whether they are hawks. And then you're basically paying attention to see when they say something that goes completely against what is expected. Another example is, imagine you have a known hawk, which is somebody who's more optimistic and favors a tighter policy. Imagine that hawk comes out and the consensus in the markets expects that particular economy to grow by, let's say, 3%. And then suddenly you have the central bank hawk coming out saying that they actually expect growth to be much, much lower, maybe 2% or less than that. that's going to be a shocker, and that could see markets start to price in a more dovish stance in upcoming meetings if the hawks suddenly start to turn more dovish, if that makes sense. So in the same way, you can always approach central bank policy meetings also from a hawkish and a dovish stance. So if a bank is currently in a deep cutting cycle, they are most likely going to be perceived as a dovish bank right now. And they are, if they are deep in a hiking cycle, for example, they're going to be perceived as a hawkish and taking a hawkish tilt right now. And the trading opportunities really comes in when the bank portrays a policy stance or performs a policy action that goes against the market expectations. So, for example, imagine that the bank is expected to cut rates at an upcoming meeting, and they are expected to also deliver a very dovish message about the economy and the policy. Now, imagine on the day of the meeting that they do cut rates as expected, but instead of coming across very negative and dovish as the markets were anticipating, they come out a lot more positive about the economy and saying things like, things have been going much better than we expected, and we're not sure whether cutting anymore would really have a very big risk-reward payoff in the coming months. Now, most inexperienced traders would simply sell that particular currency because the bank cut rates. But the cut was expected by the markets already. And instead, the market will be buying that currency, not because of the rate cut. They're buying the currency because the overall message, they got the rate cut as expected, but the overall message that was expected as dovish came in less dovish than expected, or more hawkish than the markets were expecting. Similar story there for a bank that is expected to actually cut rates at a meeting, and then they come out actually not cutting rates. Expectations of a dovish move, and then they come out actually with a neutral or a hawkish move. That's going to create some of the best trading opportunities out there. So it all comes down to what the market is expecting from a particular central banker or a particular policy meeting. And then you're basically waiting for a divergence in that policy stance or a divergence in that policy action compared to what the market was originally expecting. So I hope that helps, Felax. Any other questions, please don't hesitate to let us know.